Morning, everybody. Thanks for joining us for our regular Thursday discussion. Pierre Muller is with us today. He's going to be talking about Old Mutual, which is part of his portfolio of stocks that he researches. As usual, the disclaimer is on the screen for you to read. As much as we try and provide you with accurate information, it mustn't be construed for investment advice. You need to do your own homework before deciding on trading stocks. I mean, we've all seen how volatile the markets are at the moment. But I mean, obviously, we try and give you valuable information as we've done in the past. And we are happy today to have Pierre with us to enlighten us a little bit about one of the behemoths of South African financial industry, being Old Mutual, playing a part in the life insurance, short-term insurance, asset management game. And it'll be interesting to hear your thoughts on Old Mutual, Pierre. You can take it away, and then we'll deal with Shaun's technical bit, and then I'll have a quick chat about derivatives. We'll do Q&A first, and then I'll have a quick chat about derivatives at the day. All right. Thanks, Pierre.
Thanks, Sarel. Good morning, everyone. So we're looking at Old Mutual, and it's just before it releasing its half-year results, which we expect would be at the end of August. So taking a preemptive approach here. So if we start at the overall environment, so we see the pressure on consumers as we would expect with inflation and also the rising interest rates. So our biggest concern is currently on the persistency rates on the life insurers. And then also in the industry, it's quite a competitive environment. We don't expect the overall market to grow that much. So it's more about a bit who's a bit of a pie here. Then also in this competitive environment, we see the banks also entering some of the more basic type of policies. And then looking at the valuation fund specifically for Old Mutual, we deem it as close to its fair value. It has currently a 0% upside, so at our intrinsic value. And also if you look at the historical pricing multiples, they're also close to the historical averages. So what would change our mind on Old Mutual, it usually had a bit lower profitability compared to other insurers. So if this improves and it can be maintained as well, that would be positive for Old Mutual, and also combined with the growth, as mentioned, this is a difficult environment for the insurers. So if we look at the next slide, we can see that during the trading update where they released their first quarter results, so it didn't provide that much detail, but the sales volumes were reasonably flat. But if you exclude there being a China channel product, which they cancelled, it was up actually 7%. So they still maintain some growth. And this was in the mass and foundation cluster, which is positive, as this is also a more profitable cluster compared to the others. Management also cited that the persistency remains under pressure, which is our concern. And they also mentioned in the call that they don't expect the basis to be changed yet. Usually they don't do that at half year unless it's material enough. So there is a chance depending on how severe it is. Also on a positive front, they've seen gross inflows increasing. And that's with clients moving to your low risk type of products, money markets, fixed income types of sorts. And then on the gross written premium, so that's your general or short-term insurance, there we've also seen the trend of premiums still increasing. So seeing growth there, but just remember this is a smaller portion actually of the entire business. So shouldn't move the needle that much. The solvency ratios were guided to remain stable and within the range of 170 to 200%. And last year it ended up at the top of the end of this range, so 190%. So we expect these ratios to still remain healthy. Okay. Then just talking a bit specifically to the persistency. So At the top graph, you can see here we've taken the combined persistency impact on the embedded value. So this is a negative impact on the value of the business. And you can see how as the repo rate, so the interest rates decreases, this persistency also decreases, and as it increases, it increases in line with that. So in the bottom graph, you can see the impact of this on the embedded or the equity value overall, the value of the business. As we can see there in 2022, it had a 1.5 billion negative impact on the value, and the business overall has about a 90 billion group equity value. We also did a quick initial assessment on the two-pot retirement system, which will be implemented next year. So we expect there to be some initial outflows, but due to the business not having a major contribution from the investment side necessarily, our assessment seems that the impact shouldn't be too material, but we will keep on monitoring this. Then just recapping a bit on the different clusters of Old Mutual, so looking at the life annual premium equivalent. So this is a measure of their sales volumes. You can see here the size of the different businesses, but also what happened in the past couple of years. So they did lose some market share on the mass and foundation and the corporate side, but in the prior year, you could see them regaining the market share again with some growth there. So we're hoping they can continue this trend. Although, yeah, we want to still see what's how sustainable they can do that. And then in the next slide. So the value of new business margins, looking at the profitability of the new business obtained. So due to the prior year, they were able to increase these sales. So then they would have benefited from those economies of scale. So you would see that volume and new business expenses, they had a beneficial impact there on the profitability. Then also due to the product mix, they had a benefit due to the growth in the mass and foundation cluster. As mentioned earlier, this is a more profitable segment. The negative impact of the assumptions and models here is management already noted in the prior year, the persistency that ticked up. So they increased their assumptions there, and this would have been a large contribution to this negative impact. And then they also have a slight tax benefit as corporates are being taxed less with year ends being March 2023 and going forward as the rate goes from 28 to 27% in South Africa. You can move to the next slide. So if we're looking at the share price performance, if in the past year, Old Mutual has outperformed the benchmark, although when you're looking at longer periods, it would have underperformed the benchmark. And then lastly, just when we're looking at the valuations currently, I think I just have a bit of a delay on my side on the presentation.
I can see the assessment slide, Pierre.
Oh, okay. Sorry, then it's just on my side. Okay, but I'll talk to it anyway. So on the valuation front, based on a historic pricing multiples, it's at a historic average, and also on our valuations, we see it also at trading at a fair price. So we don't see any additional up. So it's trading at a fair price for the current environment that we think at the moment. And that brings me to the end of my side of the presentation. Thanks.
Thanks very much, Pierre. Let's jump over to Shaun. Shaun, anything in the technicals we should be looking at?
Hi, everybody. Yeah, not much. Obviously, the trend at the moment is all bullish because it's trading way above all its moving averages. This is until yesterday's close. The share price has broken up above that little resistance trend line. It's trading at about 12.41 this morning. So it looks like it's still got some upside potential. As Pierre was saying now, the intrinsic value is about 12 Rand. You can see it there on the screen. So we anticipate breaking up above this short-term trend line might go and test that longer-term resistance trend line, or that level up top there, 1260. But at this point in time, it is bullish, and it's confirmed by the MACD indicator also being bullish in overbought territory. Okay.
Thanks, Shaun. Yeah, but largely a sideways story. I mean, if you look at it from post-COVID, I think it's made two significant pivots around 1445, which was early 2022, and then 1690, which was sort of in the middle of last year, and then that 1260 pivot there that was made earlier this year, March this year. But like Pierre says, no real reason for the stock to rally hard or run away, although that said, this is one of the favorite traded stocks by our clients, and the reason for me, when I look at the technical chart like this, is all these moves are actually quite protracted. When it starts moving in a direction, it tends to move and keep moving in that direction for at least 2 to 3 months sometimes. Old Mutual. So a nice stock, a nice steady stock to trade. But like Pierre said, intrinsic value is slightly lower than the current share price. We're trading at resistance levels, looking at the lines that you've drawn there, and we are close to a recent pivot point, which would provide more resistance. So yeah, not much in it. I agree with Pierre's take. Pierre, I saw a question earlier on that Clive put in the chat for us, so let's fire away with the Q&A and see if there are more questions. Clive's question was, what is your view on Sanlam?
So Sanlam, yeah, we actually have Sanlam in our portfolios. We don't have Old Mutual, so we actually prefer Sanlam. So good question there. Sanlam did actually perform quite well year to date. I think it's up about 26% there about. And then our view, so what we like when looking at the insurer space from Sanlam, it has more diversification, which I think it's a good thing for the insurers, as you don't always know where the risks are going to come out from in your short-term life space. So that diversification benefit is one. So Old Mutual has a lot more just life, where Sanlam has a larger portion of the Santam as well in the short-term insurance, and not only in the type of products, the diversification, but also on a geography. So globally, Sanlam also has a larger portion that's offshore. And when I say offshore, that's mainly in Africa and Asia, Asia being more India. So that's also a benefit there. And then on the profitability side, Sanlam is also at a higher return on equity, and also looking at the average for the past 5 years or so compared to Old Mutual, where Old Mutual's return on equity was below its cost of equity. So yeah, so that profitability side is also better in my view for Sanlam, and it was also it's a more stable business if you look at the year-on-year type of margins or return on equity that they get. It doesn't fluctuate as much as Old Mutual.
Thanks, Pierre. So Sanlam over Mutual from a portfolio perspective, but bearing in mind that Sanlam has already given a return of 26% this year, so probably not worth chasing after it. Any further questions from the audience? Guys, you're welcome to type it in the chat, or to just put up your hand and ask it out with your mic on and preferably your camera on, so that we can put a face to the voice. See, the guys are saying, thanks for your feedback on Sanlam. Pierre, thanks very much. I don't see any further questions. So, yeah, I think I'm going to jump straight into the derivatives presentation. I'm going to take over the share here, share my screen, and then quickly take the guys through, take them a bit further on the derivative question that we had a couple of weeks ago and explain derivatives to them. You're welcome to drop off, Pierre. Thank you very much for enlightening us. Those guys that do want the presentation sent to them, Pierre will share it with me, and then you can just send me a mail at sarel.snyman@PSG, and I will gladly forward it to you. Another request that I have is we're currently in the Stockbroker of the Year survey, where we gain great insights into how our clients perceive our services, what we can improve, what they enjoy about our services, and so on. And it really gives us proper insight in how we can improve our offering and where we stand in the market. So if you'll see at the bottom of the invite that I sent you is a link to the survey. Please, the survey is open until the end of the month, but it's quite a lengthy survey. I know it's a bit of work, but I kindly request that you complete the survey for us because, as I've said, we gain insight from it and get to improve our offering to you, gaining from those the feedback that we get from Intellidex. So please complete that and do me a favor. Once you've completed it, just pop me a mail to say that you have completed the survey, because we're also keeping tabs and account on which clients have or have not completed the survey. I'm going to jump straight into the derivatives part now. I don't see any further. See, Clive says he didn't get the invite. Oh gosh, Clive, I'll send it to you. I'll send you the link. If there's anybody else who didn't get the invite and who's just attending on the regular meeting spot, please drop me a mail and I'll gladly send you the link to the survey. I'm going to start sharing here. Let's go there. So over the last couple of weeks, we've been chatting a bit about the use of derivatives and how that works. Let me just see if I'm on the right spot here. Oh, don't want to color it. Right. So in the first session, we described what derivatives were and that they were derived from an underlying asset. We touched quickly on some of the terminology. In last week's session, we spoke about hedging versus speculative position taking, and we spoke briefly about the risk and how the account changes. Today, I'm going to take it a step further, and I'm going to talk about the terminology that's used. So typically, when you place an order in a stock or trading a derivative, you'd be saying that you're going long. So you're buying that asset or contract to benefit from a rising price. The benefit of a derivative over a normal equity position is you can go short. So you can sell something that you don't have to benefit from falling prices, because remember, as we've said, settlement only takes place in the future. So you can sell something now at a price if prices fall, and you can buy that same asset from someone else to deliver in the future. You can benefit from the price discrepancy. Right. To close a position, obviously, you would have to sell the long position and you'd have to buy back the short. There's expiration dates to stuff like single stock futures contracts. They run in quarters. Typically, the closeouts around the middle of March, June, September, and December. But you can roll over that position into the next contract. CFDs don't have an expiration date, and they are open-ended, so you don't have to roll over. The initial margin we've spoken about quite a bit, and we've said initial margin is the good faith deposit that I put down, and the seller also. So if I'm buying or selling, it doesn't matter. Both parties put down a good faith deposit, which is the margin, which is the way of guaranteeing that they would perform on the terms of that contract. The variation margin adjusts the cash position in relation to the movement of the price on the asset, and that's done on a daily basis through a system called marked to market. I've touched on rolling a position into the new contract, and so that when your contract expires, In fact, on the single stock futures, we automatically roll the guys 3-4 days ahead of the expiration date into the new contract. So it's not a risk that you lose your exposure. We'll automatically roll you unless, of course, you explicitly request that we don't. And then the underlying instrument is the basis of the derivatives contract. It's the asset that forms the basis of the valuation of the contract. So if it's a share like Old Mutual, your Old Mutual CFD would have Old Mutual shares and the value of those Old Mutual shares at the bottom as the basis of the valuation. So let's quickly have a look at the differences between a CFD if we compare it with a traditional share. So the CFD doesn't have a physical equity holding, whereas the CFD, whereas the traditional equity trade would be holding the share registered in your name. You don't have to pay STT on the CFD, but you do pay securities transfer tax on the equity. You have no voting rights on the CFD. You can vote on the equity and you earn real dividends on the equity, whereas on the CFD, they would pay you a synthetic dividend, which is effectively the amount of the dividend received by the actual shareholders. So if the dividend was 50 cents after dividend withholding tax was taken off, you would get a 50-cent benefit, but it's not an actual dividend that's paid to you, and it's not entered into your tax cert as a dividend. Right. CFDs and equities have 1-to-1 ratios. So a CFD is not a contract like a single stock future that has 100 shares. You can buy one CFD in Old Mutual and have exposure to one single share the same way as you can buy one Old Mutual share in the market. The only difference is that you've got leverage trading and you only pay the margin required or the good faith deposit required, typically between 15 and 17.5%. The settlement period on the CFD trade is T+1. It's quicker, and the settlement period on the physical equity is T+3. So trade date plus 3 days. On the tax side, slightly different. We know that if we hold equity positions for longer than 3 years, it becomes a capital gain, which results in a lower tax being paid. Unfortunately, when you trade in derivatives, you consider a trader, and it's added to your personal income. So the tax rate on derivative profits slightly higher than the CGT. It's easy to short a CFD trade, whereas you can't short a physical equity in South Africa. We typically hear the Americans speak on business channels about short positions in equity, and there you can actually borrow the scrip and short the stock. Over here, we do it through the derivatives mechanism. So you can short, bearing in mind that there are costs involved. If you borrow somebody's scrip or paper, then you typically pay them a fee for it, and it's priced into the price at which you will then sell the CFD. CFDs are obviously traded over the counter, so there could be counterparty risk. I wouldn't trade CFDs through fly-by-night shops who offer those CFDs, because you'd be taking the counterparty risk. I don't think you have any of that with a company like PSG, and we typically go one step further by having those derivatives or the CFDs then traded through one of the banking partners, in our case being RMB, who provides our CFDs for us. So you have absolutely no counterparty risk when trading with a company like us. I see it's 5:02. I'm gonna leave it there, and next week I'll explain the difference between CFDs and single stock futures, and then we'll also get into looking at the actual cash flows that take place between in your account if you do hold a derivative position. So to explain it further, as the stock price moves, what happens to the cash and margin in my account? Just have a look at that. Then let's see here. I'm going to go back to the chat now and see if there were any questions on the derivatives that I can maybe help you with in the last 5 minutes. Let's see here. Sarel, if I own a stock, how do I lease it out to CFD or short traders? Okay, Stefan, I guess you're asking, can you borrow your script to somebody else who wants to short sell the particular stock that you're holding? Can you just give me an indication if my interpretation is right? If that is the case, yes, we can use your stock to lend it, although we don't have.
Sarel?
Yes, Stefan.
So I'm not sure if I'm using the right term here in lease, but in any case, can I rent it out to someone else? If I physically own the stock, can I rent it out to someone else, get paid for it while somebody else shorts the stock? Because I guess in essence, if you short a stock, you have to borrow it from someone else, and pay them for it.
I'll tell you what, we don't have a particular mechanism through which we do it, right? And bearing in mind that the derivatives that we trade in is the top 100 stocks, so there's not always a shortage in the stock for settlement, although we do get requests from the JSE sometimes to say, hey, we've got a failed trade and the guy can't settle, can we borrow stock from you? But it's typically illiquid stocks in that they want to borrow from us in that instance, because the banks who act as market makers on the single stock futures and are very active in the CFD market, that they typically have enough stock to lend. So in a case where you as an individual would want to lend your stock for a fee, there is a fee. I mean, the JSE pays R1,000 per script that you lend. So if you hold, irrelevant the size of the position, but I mean, if you lend your Old Mutual stock to somebody else who shorted it, then you would be receiving $1,000, but we don't do that as a product. And we don't get those requests often, if that does answer your question.
Thanks.
Okay, and then I have a quick poll for you, because I see a lot of people have stayed on to learn more about derivatives. And I was wondering this morning whether you would actually, whether we should maybe have a get together and do a full session on derivatives. I just want to activate this poll quickly, and I was wondering whether you would actually attend something if we hosted it at our offices. And then, or whether you would prefer for it to be done online. I personally think that doing it in person has greater effect, because then you also have the freedom and it's easier to ask questions and get them answered straight away than doing it through the online methodology. But I realize that we're living in a tech-driven world, so we can certainly entertain that. So I want you to quickly fill out this poll for me, if you can see it on the screen. I said, would you attend a late afternoon or evening class on the use of derivatives if we hosted it at our offices? I'll throw in a snack and a beer. And if you just answer that, or then the options are yes, no, or rather host it online in the evening. Let's see what kind of answers we get. Quickly complete that for me. Let's see how many responses have we had here. So far, it's overwhelming online. 13 responses, and most of the people say that we should host it online. Okay, so what we'll do is we'll look into it, and we'll see if we can get something together, send you guys invites, and maybe create awareness in this meeting of such an event taking place, and then we'll have a proper online discussion about different topics. Maybe derivatives is not the only topic you want to discuss, so you're also welcome to drop me a mail and say, hey, I wonder if other people would be interested if you handled this topic from an education perspective, or just maybe we should get Vaughan in the room and just talk about equities in general. So let me know what suits. By the way, Vaughan will be back with us next week. We look forward to that. I see we've run out of time. Guys, thank you very much for partaking in our session today. 77% of people have agreed that 71% now said that we should do it online, and we'll certainly arrange it that way. Thank you very much for attending. If you have any further questions on Mutual or Sanlam or so, pop me an email and I'll try and get the analysts to reply to your requests. I hope you have a fantastic day, And thanks for joining us. We'll see you next week. Cheers.